Okay, so today's personal finance subject, investment principles. As in, when investing, what are the main factors that might determine whether an investment is suitable for a particular person or unsuitable? Before I begin, I should stress that there is no individual advice in this video. I do not know the personal circumstances of everyone watching. It's information only. I'm going to list 6 principles, and I'm going to cover 3 in this video and 3 in the subsequent one. This is my interpretation of the principles, I should add. I'm not promising it's completely all-inclusive, and you may find other sources that list more or that list less factors. So on to the first principle. The first one is actually sort of 2 aspects rolled into one, but they are inseparable. This is the concept of risk and reward. The principle is that the more risk taken, the more financial reward you can reasonably expect. However, the more risk taken, the chances of potentially losing money also increases. An example of a high-risk investment would be buying shares in a mining company, whereas a low-risk investment could be a UK government bond, for example. The second principle is what's called a capacity for loss. That is, how much money can you afford to lose? You should only invest an amount that were you to suffer a loss, it would not significantly affect your lifestyle. So someone with a lot of savings and a large surplus of income over expenditure would have a high capacity for loss, whereas someone with no savings has a small capacity for loss. The third principle may at first sound similar to the first one, but actually it is a separate point, and it interconnects with the both the first 2 points. And that is the investor's attitude to risk. This is actually a very big topic, and it's really about investors' emotions. At one extreme, some people may get very nervous about the prospect of investing or the possibility of losing money. Others may have a very gung-ho attitude, and they're happy to take a large risk for a chance of better returns. Whereas many people will be somewhere in the middle of these 2 extremes. Sometimes where people sit on this spectrum is related to how much they think they know about investment matters and how wealthy they feel. Sometimes it isn't connected with that at all. Now this is important because a person's opinion on investing and how they feel about it emotionally can cloud their ability to honestly assess their capacity for loss, see how low or high risk an investment actually is, and form an accurate assessment of how much risk they should be taking. Or to put it another way, an investor's attitude to risk, it may or may not match the actual risk they're taking, depending on their personality and other factors. That's it for today. Tune in to the next video to hear about another 3 principles. Thank you.